Government bond yields are back in the spotlight, climbing to levels not seen in decades. So, what's behind the rise? How are global factors from Tokyo to Washington playing a role? And what does it all mean for stocks and the economy? I'm Johanna Bota, and here to break it all down is Alex Ridgers, VP Global Head of Retail Dealing Desk at StoneX. Welcome, Alex. How
Hi, Joanna.
are you?
Very good, thank you.
Nice to have you back. So, let's start with what everybody is talking about. Global government bond yields rising. Why is it happening?
Yes, well, shadow governments, like those not in power, would love you to believe it's the individual government of each country, of each major country. Particularly at the moment, we're talking about the US, UK, and actually France at the moment. So they're saying it's government policy that's driving this. But actually, when we look a little bit deeper, it's happening globally. So we can't really pin the blame on any one government. So when I look deeper into this, we're seeing that inflation expectations post-COVID, I think everyone's target is always 2%. But in reality, inflation, it's becoming stubborn around 3-4%. So I think what that means is when bond investors are saying, I need to get a certain amount of real yield, i.e. interest minus inflation. So as we've moved up from sort of 2% to 3% in terms of inflation expectations over the long term, this is not just the sort of the short term. It just means that investors demand a higher return for their money. And then Japan is having a weird effect on the whole globe. The fact that inflation is back in Japan after so many years. So previously, where we had Japanese investors, if they wanted to get any yield, they couldn't invest in Japanese government bonds because they're basically paying zero. So there'll be so many Japanese purchases of foreign government bonds.
Of course. And
what we're seeing now is those investors are returning to Japan because the JGB, the 30-year, was paying 2% a year ago. It's now paying 3.2%. So it's been quite a difference. So that really has sort of stopped those buyers keeping bond prices high.
I want to stay talking about the role of government, though, because with high spending and heavy borrowing, do they bear a little bit of the responsibility there?
Yes, I mean, I'd like to remain sort of politically neutral of this and just think of the markets. But yes, it is simply a case that spending is too high. I mean, in the UK, we've seen it, where spending is as high as it's ever been. The tax burden is as high as it's ever been. And in the US, again, it's a little bit about spending, but there are other factors. I mean, I think when we look at Trump's tariffs, of course, that's inflationary. We've seen him crack down on immigration. Again, what that does is lower the supply of workers, basically, and so that's going to push up prices. Then we've just got simple tax cuts that he's kept. He hasn't sort of pushed back the tax cuts that came a few years ago. And then finally said just uncertainty, where this idea that the more uncertain things are going to be, the higher yield, the higher rate of interest that investors are going to demand.
Yeah. So what about stocks then? How do rising bond yields impact equities and equity indices?
Well, I mean, for pension funds, for private investors, for everyone really, the higher bond yields are, the more attractive they are, essentially. So higher bond yields means lower bond prices. So all of a sudden, you've got an asset paying out the same amount, but it costs you a lot less money. So this certainly is dragging money away from equity markets. It's not causing equity markets to crash. But I mean, it seems to me in sort of when we're talking about bond yields, they have actually been high for a while, but it's almost really come into the psyche. I think almost the end of the summer now, we're back into September. People are again thinking, it's why we're here to say what is going on, and it's almost just sort of rising to the forefront of people's minds that that bond yields are quite where they are. So I think in the past 10 days or so, we just have seen equity markets stagnate as people question their decisions of whether they should be investing in bonds or, I mean, actually. Yeah. To mention the last couple of days, we've seen gold rally again and again.
At an all-time high, yes.
And again, this is the bonds. There is no inflation hedge to bonds. There is no asset. It's just paying a fixed amount. Whereas gold is just a lump. It's a lump of metal. It's inflation proof. Yeah.
So we've seen the impact on stocks, but the big test comes this Friday with non-farm payrolls. What are we expecting to see in the jobs report?
Yes, this is going to be one of the biggest non-farms we've seen all year, or even I think in the past 2 or 3 years. So we're expecting 75,000 growth in jobs, which is historically very much on the low side. So this is explaining why we're expecting four rate cuts, I think through to actually before June. So by the April meeting, we're expecting, which is almost unprecedented. So this is this weird dichotomy we've got at the moment where long-term bond yields are very, very high, but there's a lot of pressure on reductions in the short term.
So one last question then. How could good numbers or bad numbers move the market?
This is what I think is the most fascinating thing, of the whole sort of bond conversation, if we get a bumper figure coming out, then that says growth, 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 growth. That's great. So from a government bond perspective, bond investors are happy. That gives them more certainty. So we should see bonds rally and a bit of stability in the long term. But in the short term, all of a sudden, these predicted cuts to interest rates aren't going to happen because we just don't need to. There is just no need. So it's almost sort of a good figure will be long-term good, short-term bad, and then a bad figure will be great in the short term because it's like, well, we really do need those cuts. We need to be boosting the economy. But again, a bad figure for long-term bond yields and government borrowing, it's a nightmare because again, it's just suggesting, wow, there's more uncertainty. Whereas, how are we going to grow to create this stability? So we're sort of stuck between, in either scenario, good or bad. It's good for one, bad for the other. So when we're looking at how do we sort of get out of this sort of quagmire, where it's not a nightmare, equity markets aren't on the floor, but there's certainly that stagnation. It seems to me to really get investor confidence back, the only way we're going to do that is actually by governments borrowing less, and just admitting that they've gone too far.
Alex, thank you so much for your insight. And thank you for watching. For more financial content, don't forget to like and subscribe to our channel.